I'm back.
Hi, good morning, everybody.
Please type in the chat box if you can hear us.
Hi, good morning, everybody. I know it's 11:02, and let's start off today's session. How many of you would like to trade in internationally traded asset classes? Please type me in the chat box. Yeah, how many of you would like to diversify your portfolio by trading into commodities like gold, silver, crude, natural gas, etc.? Please type me in the chat box. Yeah, good morning all. My name is Ramesh Varkhedkar and I head the commodities and currencies business at ICICI Securities. And I'm super excited to be here with all of you on a Saturday morning. And firstly, let me appreciate each one of you because it's a Saturday. You could have done many, many things with your family or spent time doing something else. But you all have chosen to be here on this YouTube live and try to learn and understand about commodities. So thank you to everyone. In next 45 minutes, me and my colleagues are going to run a presentation on commodities. We would like to keep it very simple and very basic for all those who would like to trade in commodities for the first time. And I'm sure we'll try to give the best of the value to all the participants. So along with me, I have my colleague Pankaj Agarwal, who will be running presentation on commodities. Then we have Somesh from MCX. And then we'll also have one presentation on how to trade in commodities. And at the end, we'll take all the questions. So Pankaj, over to you.
Yeah, thank you, Ramesh. And good morning to all participants. And see, we will like to do our level best so that all of those who have joined this session can understand about commodities, commodity derivatives. We know that commodity as an asset class is something different than equities. Most of you would have been trading in equities for long, but when it comes to commodities, it sounds slightly, new product class or asset class. So our endeavor here at this time would be to take you through the journey of commodity derivatives. How are they traded at an exchange? What are the fine points that you need to remember while you trade in commodity derivatives at an exchange? So we like to keep the session very interactive and keep it at a very basic level. And whatever questions you may have for this session, you can type in the chat box so that we can take your questions at the end of the session. So I'll start with the very basics. And you would be aware about derivatives, I hope. Derivatives basically means that a financial instrument that provides an opportunity to take a position that would be delivered at a future point of time. And you lock the price at this point of time. So this is a derivative. And this derivative could be either in the form of a future or an option. So there are two variants that are usually available for trading at an exchange, futures and options. So when you speak about derivatives, the derivative instruments could be available in various underlyings. And these underlyings could be equity, they could be fixed interest, they could be currency, they could be commodities, or any other asset class which has been permitted to be traded at an exchange. Now, when we speak about commodities, we are aware about many commodities, agri commodities, non-agri commodities, because a lot of commodities we consume in our daily life on day-to-day basis. Agri products we use, non-agri products like petroleum, diesel, sometimes other metals also knowingly or unknowingly, but we use. But when it comes to the question, are these commodities traded at an exchange? Yes, they are available for trading at an exchange. How? See, these commodities could be traded at an exchange by way of financial derivatives like futures and options. If you go to the history of commodity derivatives trading, we find that It started way back in Japan, and that got evolved in countries like US or European countries, where agriculture producing units came together to form some sort of contract so that they can lock in the price. Actually, it evolved very much in country like US, where Chicago Board of Trade Act was formed, and it facilitated a lot of farmers so that they can lock in the price of their produce for a future day. And since then, a lot of evolution has taken place. In India, a lot of commodities have been traded, and so far as the futures contract is concerned, in some areas of India like Kolkata, Mumbai, or any other area where there is a mandi, these future contracts were available in some unofficial manner or in an informal manner. I know a lot of big mandis in India, like Hapur Mandi in UP, which is known for wheat, and then cotton mandi, and then jute mandi in Kolkata, and so on. And when there is a particular product which is of dominance and importance, then Vaida Bajar or Vaida Karobar, which we say in Hindi, or futures market, it actually gets evolved or developed as a natural progression. If we look how this futures market has been developed in India, then we find that it was only after 2015 when SEBI took it over from FMC, a lot of new developments have taken place. Earlier to it, retail participants were allowed to trade in futures market, particularly in commodities derivative. After that, institutional partners, so institutional players were also allowed. And why was it done? Because if you have only retail participants in any market, then the volume and the depth will always be limited because of the limited buying power, limited trading power of individuals. And when you allow participants like foreign institutions or mutual funds, which are basically institutional partners, institutional players, then they provide liquidity because they trade in volumes, heavy volumes. And this enrich the commodities market also. Now, if we look at the exchanges, we find that there are many exchanges across the globe in commodities. See, these exchanges basically are the one which are specialized exchanges. In India, we know there is a BSE, there is NSE, and these two exchanges have been present, or they are in India and have been offering equity-related products. Of late, they have come in commodities market also. But if we speak about NSE and BSE, they seem to be synonymous with the equity market. But there are many exchanges in the world which seems to be synonymous with the commodity market. For example, CME, LME, IC, these are the exchanges which are known for commodity contracts only, because at one or other exchanges, there is a type of specialization. See, for example, LME, the contracts that you find at LME would be more of metals related. The contracts that you find at NYMEX would be more of energy related, and so on. So here at this slide, you can see we have mentioned 6 major exchanges which have a specialization in one or other categories of commodities. Now, we have spoken, we have understood about the global exchanges. What about the commodity exchanges in India? There are 5 exchanges that we know that are actually currently present in India, which provides trading in commodity contracts. If you look at the slide, you'll find the multi-commodity exchange at the top and the other exchanges following it. So this is not any sequence. We have just put multi-commodity exchange at the top and eyeball and highlighted also because of the total volume that is traded in commodities market currently. When you speak of total volume or total value, it means ADTO, average daily turnover, in commodities market currently is around 35,000 to 40,000 crore on an average basis. Of this, 95% of the volume takes place at MCX, and rest of the 5% volume happens at other exchanges. So with that, we do not mean that BSE and SE are less important exchanges, but from the perspective of commodities trading, they're still new or they are still coming up. So these, because they started offering commodity contracts only 3 years back in 2018. Whereas if you look at the timeline, MCX and CDX started their operations way back in 2003, almost 18 years now, 19 years almost. So with that, the evolution of MCX and CDX has taken place. Now, if we compare between MCX and NCDX, there is one major difference. MCX offers all type of commodities, be it agri or non-agri. But when you speak about NCDX, it offers agri commodities predominantly, right? So this is the main difference between MCX and NCDX. Now, we've spoken about commodities. Now, we know that the commodities are consumed or used by individuals, by industrial units, and so on. If we have to see the entire gamut of commodities, at the top level, the whole universe of commodities could be divided into two broad categories: hard commodities and soft commodities. What they mean exactly. Hard commodities would mean anything or any commodity that is basically available by way of extraction from the earth crust. When you speak about the soft, means agricultural commodities which will be reproduced, right? All the agri commodities could be reproduced, like all these agri products that we can see here. So this is one major difference. Within the hard commodities, again, there is sub-classification: base metals, precious metals, which we also term as bullions, and then energy. Energy is one of the most important category, crude and natural gas, because we have been often hearing about these two products or these two types of commodity contracts on daily basis. Crude oil, I know, because most of us will be keeping track of what is crude currently running, 75 barrel. Then a lot of debate keeps on going in media that why the crude oil currently, if the crude oil currently is this much, then why the price of petroleum in India is so high. So we know about crude oil. Okay, now the question arises, why should one trade in commodities? Most of you would be trading in equity or equity derivatives, or some of you would actually be trading in equity derivatives also. And they would be aware of many features there. Leverage. Leverage is one feature which actually brings an interest of the participants in the derivatives market. Because in a futures contract, you need to pay only a fraction of the contract value. For example, if the contract value of any equity derivative contract is say 10 lakh, one needs to pay only 10%, like 1 lakh or 1,50,000, 15%, but not the entire value of the contract. And likewise, in the commodities derivative contract, one needs to pay only the margin money. And this margin money could be in the range of 5% to 15%. For some commodities could be 5%, and for other commodities could be 15%. And it all depends upon how that commodity is seen, how risky that commodity is. So based on that, the margin percentage is calculated. And this margin percentage is calculated or governed or maintained or managed by the exchange, and any broker or any participant who provides the facility of trading only pass it on to the traders. They do not have any say in that. Liquidity. See, liquidity is an important element, because nobody would like to trade trade in any asset class which has very less participants. For example, if you trade in equity derivative of Wipro, and Wipro futures contract have very less number of participants, say just 100 or 1,000, nobody would be interested, because then it becomes difficult for the trader to enter and exit at a desired price, and the bid ask price would also be very wide. So liquidity is very important. And when we see this thing in context of commodity derivatives, we find that all the commodity contracts that are available for trading at MCX, they have good liquidity. Means any trader can take a contract at a desired price which is available in the market, can enter and can take an exit. So there is no waiting period for a person to, means when the desired bid ask price come, and then person will take a call. So liquidity, many number of participants are available and they trade in a particular contract. Usually, good liquidity has been seen in the current month contract and the next month contract. Diversification, as Ramesh introduced this commodities, in the beginning, it is an asset class, it provides diversification. And how does it work? See, for example, if you have been taking position equity, fixed income, mutual funds, real estate, etc., then those are asset classes. And like those asset class, there is an additional asset class, which is commodity, which gives an opportunity to put our money into a new asset class, because we know that there's an equity, there's a mutual fund, there's a debt. Then what else? What next? So commodity provides the answer to it. You can put your money in commodities. That will provide a different type of returns, of course, in a leverage form, but it provides an opportunity. Within the commodities also, there are a huge number of commodities, as we saw that hard commodities and soft commodities. So intra-asset diversification is available in commodities. Inflation hedge. See, inflation hedge would mean that any asset class which has a potential to provide a return in addition to the ongoing current inflation index. For example, if the current inflation rate is around 6% on the terms of CPI, Consumer Price Index, then is there any commodity which provides a return in addition to it, say 1% plus or 2% plus? Yes, there are commodities which has a potential to provide an additional return, right, compared to inflation. Gold is one such commodity, because we have seen that over a long period, the price of gold keeps on rising. So if you recall, in year 2019, the price of gold during Deepavali was around 38 to 39,000. Now, if we look the price of gold, which is currently going on, it is around 47,000 plus minus something. So, over the last 2 years, there has been a good return in gold compared to inflation. While inflation would have been around 6% per annum, the price increase in gold would have been much more than that. Not transparency. See, transparency is very important. Nobody would like to trade in a market where there's opaqueness, because opaqueness means there is a lack of information available, public information to the public. Some information is not available, which could be useful for trading, which may happen in equity market. Because what is happening in a company or in a industrial unit, you do not know, and the share price of that unit or share price of that company may get affected because of some other reasons. But in case of commodities, the price of any commodity, you take gold, silver, or metal, or any commodity for that matter, would not get influenced by any single individual or for any single industrial unit. So this is transparency. And this has a pull factor. Most of us would like to trade in a market where there is a transparency, where the price are not manipulated. So these are the reasons which makes a commodity derivatives market an interesting market and brings the interest of traders in this. Now let's try to understand the difference between equity derivatives and commodity derivatives. This is important for us to understand so that we can understand what are the basic differences and why should we trade in commodity derivatives vis-a-vis equity derivatives. Now, when we speak of equity derivatives, from the exchange perspective, the trading window that is available is for approximately 6.5 hours, from 9 a.m. to 3:30 p.m. One can trade in equity or equity derivatives for approximately 6.5 hours in a day. Now, when you speak of commodity derivatives, the trading window is available for a much longer duration, right, from 9 a.m. to 11:30 p.m. or 11:55 p.m. So for approximately 14.5 hours or 15 hours approximately. How does it work? See, during 12, in a year, for approximately 7 months, the timing is from 9 a.m. to 11:30, and for rest of the 5 months, it is 9 a.m. to 11:55. So these 7 months for 11:30 would be from March, sometime from March, say second week of March till November, and from November to March, it would be 11:55. The longer period would be available for trading in commodities from November onwards. This we will, so November is coming, more 25, extra 25 minutes would be available for trading in commodities. And another important distinctive point here is the margin. See, when you trade in equity derivatives, whether you trade in Nifty 50 or Bank Nifty or any stock, you have to pay margin which could be in the range of 15% to 25% or even higher than that. But when you speak of commodity derivatives, the margin requirements actually on the lower side. Let's take an example. For example, somebody puts a trade in Nifty. The margin requirement could be around 15%. Say, in absolute terms, it could be around 1.75 lakhs. But when you trade in gold, the margin requirement would be around 10%. So depending upon type of contract one is taken in gold, say gold pattern, the margin requirement would be just 500 rupees. So the margin requirement, initial percentage is very balanced. It's on the lower side, basically, compared to equity market. Now, one more point which makes commodity market very lucrative is the volatility. See, would you like to trade in the market where there is less volatility? I hope we understand volatility. Just still, volatility means the price, the percentage by which the price fluctuates. Now, if there is no fluctuation in the price of, say, Reliance or Wipro share, would you like to trade in that? Because if you're an investor, you will like, because then you will like to buy the share, like to hold it for a longer period, for 3 years, 5 years, and 10 years, and the price will appreciate over a longer period. But when you speak of trading, day trading, or trading for a period of shorter period like 2 days or 5 days, then it will not provide an opportunity because there is no price movement. So if you buy any share for 2,000 and it remains at 2,000 over the next 5 days, there is no opportunity. But there is an opportunity. So people trade in equity market. But when we compare it with the commodities market, the volatility, this price change, plus or minus, is very high compared to equities market. So during a day or during a shorter period of 5 days or 10 days, the volatility in the price of many commodities could be very high. Say in crude oil, natural gas, for that matter, silver, nickel, you'll find that price of these metals, they fluctuate and fluctuate heavily. And because of that, many people find interest to trade in these commodities. So these are the key distinctive points when we compare commodity derivatives with the equity derivatives. So we have understood about the some economic factors and other things, and why should one trade in commodities market. Now let's try to understand, when we trade in these commodities or commodity contracts at an exchange, what are the specifications of these contracts? See, when you go to the market and buy gold, you buy gold in 1 gram or 10 grams or 100 grams or 1 kg as per your desire or as per your monetary ability. But if you trade in gold contract at an exchange, is it that gold is available on a specific quantity only? No. Again, exchange provides you the facility to trade in gold in variants. You can trade in gold 1 kg, you can trade gold in 100 grams or even 1 gram. So depending upon the type of money you are willing to put in any derivatives contract, in gold futures for that matter, you can take position in any one of the 4 contracts. While gold mini is just 1 gram contract, gold is 1 kg contract. Rest of this contract specification more or less same. Say they are available for trading right from 9 to 11:30. So there's no difference. If you trade in gold petal, you can trade only till 9 o'clock, and you trade in gold, then you can trade till 11:30. It's not there. You can trade till 11:30, 11:55 till the exchange is open. However, there is one unique thing that we need to understand about the quotation unit. See, quotation unit is the normal term which we use for any metal with reference to price change. When you go to market and when you buy gold, you say that I want to buy 1 tola or 2 tolas of gold, right? Or say 100 grams gold. And the price is communicated to you on the basis of 1 tola. It's not communicated on the basis of 1 gram or say 100 grams. So tola or in the spot market is a common term, is a term which we know about it. And likewise, when you trade gold at an exchange, there is a term which is used to refer the price and for price change, the smallest price change. So that is 10 grams for gold and gold mini, and for gold guinea and gold petal, that is 8 grams and 1 gram respectively, right? And whenever there is the smallest price change in the contract value of gold or any other gold contract, it is by rupees 1 basis quote unit. I know this may sound slightly complex, but you need to visualize this way. For example, you take 1 kg gold futures contract at an exchange. The 1 kg would means 1000 grams. And if there is a change in the price of gold, at an exchange, the price would always be made in the multiples of 1. So the minimum change would be by rupee 1. So if currently gold being traded at 47,000, the next change that will come in the gold price would be of 47,001 rupee, 47,002 rupee on the plus side. On the minus side, it will be like 40,001 rupee, 47,000, 46,999. that way. And since it is rupee 1 change for 10 grams, and if you take 1 kg gold contract, the multiplier would be what? 1000 divided by 10, 100. So for 1 rupee change in gold futures contract, the total value change will be of 100 rupees, right? We have given it here. Likewise for gold mini, gold guinea, and gold pattern. This presentation is available at our website. Those who are customers of ICICI Direct can go to commodities, can download this presentation. And those who are yet not our customers, we strongly urge them to open their account and trade at ICICI Direct. Okay. Likewise for silver. Silver, as we have seen, there are 4 variants in gold. There are 3 variants in silver contract: silver, silver mini, and silver macro. And rest of things remain same. There's a quotation unit, there's a tick size movement, and so on. Basis the size of contract, the change in value in absolute terms would be affected. So if it is silver macro, which is basically 1 kg contract, so 1 rupee change will bring 1 rupee change in the contract value. And if it is silver mini, which is a 5 kg contract, so just see the multiplier, 5 kg. So if there's a 1 rupee movement, there will be 5 rupee total movement in that futures value contract for silver mini, and so on for silver. Now, similarly for the base metals. In base metals, there are 5 metals which are available for trading: aluminum, copper, lead, nickel, and zinc. And we are aware about these base metals because though we might not be using these base metals in our daily life, but industrial units use these base metals as a raw material. So most of the industrial units would have an interest to trade in these base metals. Of course, an individual could also trade in the base metals. There is an option that we will discuss about it. Prior to it, we'll discuss this thing. See, there's a calendar which we can see here. Now, we have spoken about gold, we have spoken about silver, we have spoken about base metals. But the question comes that if there is a contract, futures contract available for trading in a month, could trading be done in that contract throughout the working days or throughout the entire month? See, any contract, if it is a monthly contract, if it is expiring on last day of that month, usually would be available for trading till last working day, except for the delivery or staggered period. In some cases where trading is not allowed during the delivery period. Okay, let's try to simplify it. For example, there are 2 brokers. Broker A, which provides trading in that material, in that commodity for trading throughout the month till 31st. In this case, broker B may not allow trading for the entire working days. They may allow trading till 24th only, because from 25th onward, the margin requirement will increase. In case of gold, if the margin requirement is 10%, then the 10% margin requirement would hold true till 24th, or till 24th, one need to pay only 10%. But as soon as 25th starts, then the margin requirement will increase by some percentage, could be by say 10%, for example. So on 25th of that month, the margin requirement will not be just 10%, it will be 20%. On 26th, it will again increase by 10%, say, and it will become 30%, and so on. Why? Because during last 5 days, the delivery period starts, and it means that if somebody is interested to take a delivery, would need to pay extra margin. Now, in our example, we have taken 2 brokers, broker A and broker B. So broker A may allow participants to trade till 31st, and in that case, the participants will need to pay additional margin every subsequent day. But in case of broker B, trading might not be allowed, and on 24th, all the open positions might get squared off by their system, or the traders can square off their position at their own, right? So during the delivery period, trading might not be allowed. ICICI Securities does not provide trading during the delivery period as of now. In future, it may allow, but as of now, it doesn't allow. Now, this delivery period is applicable for base metals and for precious metals like gold, silver. So for these 5 base metals, it would be applicable. For these 3 silver contracts would be applicable. For gold, it would be applicable. Now, when it comes to crude oil and natural gas, there is no delivery period. So one can trade till 31st in this, in case somebody is taking a contract in crude oil, natural gas, then one can trade till 31st. However, one still would need to pay an additional margin, but not by that higher percentage, but at a static rate of 5%, because crude oil and natural gas have been considered very volatile commodities. So recently only exchange has introduced this pre-expiry margin, which is actually additional margin only for crude oil and natural gas. So additional margin would be applicable in case of crude oil and natural gas. So what does it mean? In case of gold and silver, system will square off the position. And likewise, in case of crude oil and silver, system will not square off the position, but additional margin will be applicable. But if margin shortfall, then because the shortfall of the margin, then position would get squared off. So there's a difference. Okay, now cotton and CPO, these are agri products. If you go to M6, you'll find that M6 offers a large number of agri contracts. But at our platform, at ICICI Direct, we offer only cotton and CPO. Now, if you look the agriculture basket of commodities, all the agri products are supposed to be domestically referenced product in terms of price reference. But cotton and CPO are two commodities which draw their price from international market. And they're also known as internationally referenceable commodity. Right? So how are they different? One can trade in cotton and CPO from 9 a.m. till 9 p.m. But if any other agri product is available, then the trading would be available from 9 to 5 p.m. only. So additional trading window is available in these two commodities. Apart from agri, all non-agri will continue to be traded, or they are available for trading till 11:55. So you can put a trade in gold, silver, natural gas early in the morning, say 9 a.m. or 9:30, or at 9:30 or 10 p.m. also. Those are the commodities which would be available for the entire day until 11:55. Now, here we will understand very interesting contracts. All those who have joined this session, I think they will be aware about a common term like Nifty or Sensex, because these are two terms which basically indicate how an economy is doing, how economy is moving, in which direction. Currently, these days, not economy, but how the stock market is moving, right? Sensex has moved up. Sensex recently has crossed 60,000 mark, and Nifty is also moving up high and high. Those are the indices, and indices basically comprise the value of some a basket of equity shares. For example, Nifty represents the composite value of 50 stocks, 50 top traded stocks of market capitalization. Likewise, Sensex represents the composite value of 30 stocks on the basis of market capitalization. And not all indices, but the major indices are available for trading. One can trade in Nifty futures, one can trade in Bank Nifty and some other indices also. Similarly, in commodities market, M6 has come out with a broad-based index, which is known as ICOMDEX. Currently, that is not available, but as a subset of that, it has come out with sectoral indices. Means that it has created few indices based on a particular sub-classification of commodities. And we know there's a hard commodity classification, and below to it, there is a base metal, precious metals, right, and energy. So on that sub-classification of base metals and energy and bullion, they have come out with an index or indices. Two such indices which are currently available for trading and available at ICICI also are Boldex and Metaldex. Energy Dex is again a new index which has come out, and ICICI would be offering that also. So in next few weeks, that would also be available. But if we speak about Boldex and Metaldex, we'll find that Boldex is based on gold and silver, precious metals, bullion, right? And metal dex is based on 5 base metals. And there is some weight which is given to gold, there's some weight which is given to silver. This keeps on changing. What is the advantage of trading in indices, in commodity indices? Suppose you want to trade in gold or silver, and you want to trade in both gold and silver. Then you have to pay margin for gold contract, and you have to pay margin for silver contract separately. And you have tracked, then you need to track both the positions. And your margin requirement will also be on the higher side, in terms of percentage and absolute terms also. Let's try to understand. For example, you take a position in gold 100 grams, gold mini. The requirement of margin in gold in percentage terms would be around 10%. And since gold mini contract values of 5 lakh rupees, you have to pay 50,000 approximately in gold mini contract. At the same time, you feel that silver can also provide good returns in terms of trading. Then you are willing to take position in silver also. And silver 1 kg, on the basis running rate, the margin requirement percentage is 12% or 12.5%. Just see, in gold it is 10%, in silver it is around 12% approximately. And for 1 kg silver, the margin requirement would be around 7,700 and so on. So you have to pay 57,700 to take a combined position of gold and silver. What if there is a contract available that can provide you to trade in both gold and silver at the same time without putting money in 2 separate contracts and tracking those contracts separately? BullDex provides this opportunity. And the margin requirement is also on the lower side. It is just 6.5%. So basis of contract value of BullDex, which is currently around 7.5 lakhs, the margin requirement could be around 48,000. So much lesser than 57,000. So by paying lesser amount, one can take position both gold and silver, right? And that too by paying lesser percentage of margin. Similarly in metal dex. And these indices, when available for trading, when they are available for trading, could be traded till the last. See, there is a cutoff period. So till that date, they are available for trading. There is no delivery period, margin, or nothing like that. And they're all settled in cash. Okay. This we've already understood. Now we come at the slide or the point where we need to discuss about brokerage. At ICICI Direct, the brokerage that we charge is just rupees 20 per order on buy side, and similarly on the sell side 20 per order, irrespective of number of lots you put in one trade. For example, you say that I'm interested to buy 1,000 lots of gold pattern. So what would be my brokerage? Brokerage will be just 20. It will never be multiplied by 1,000. So whether you take 1 lot or you take 1,000 lot, brokerage would always be rupees 20 at ICICI Direct. We are very competitive, and that keeps us ahead of the race. And when you speak of non-brokerage charges, there are a couple of non-brokerage charges which are levied or any contract, and they are basically charged by government or by related bodies. For example, after brokerage, then there is a exchange charge, transaction charges. This is taken by exchange. Then there is a SEBI charge. Then there is a CTT. CTT is taken by the government, which is applicable on sell side. There is a stamp duty, which is applicable on buy side. Please remember, only CTT and stamp duty are applicable on one of the sides of trade. Other charges are applicable on both these sides. One other point of the all non-brokerage charges, CTT is on the higher side. Means if you buy 1 kg of gold, value of the contract would be what? Around 50 lakhs. Brokerage would be what? 20 rupees on the buy side. And when you will square it off, the brokerage will be again 20 rupees. So you would pay only 40 rupees to ICICI Direct. However, there would be other charges also. Other charges except CTT would be very less. They would be around some 20-30 rupees depending upon the contract value. But CTT will be very high. CTT on 1 kg buy and sell of gold would be rupees 500, because it is 0.01% on the turnover value on the sell side. So when you sell or when you square off the gold futures contract, you would need to pay 500 as CTT. So in the contract note, when you find that the total charges have been taken around, say, 600 700, please remember 40 rupees are only brokerage charging. Rest of the other amount is for non-brokerage, including CTT. Okay, now from here on, Sumesh will take you, and will guide you the important points regarding MCX. Sumesh, you can take it over.
Can you hear me?
Yes.
Yeah. Would you be sharing the presentation or should I do it?
If you can do it, because then you can control.
Oh, fair enough. Then in that case, you need to allow me a minute, please.
Sure, sure. So Sumesh is about to share his presentation. Bear with us for another few minutes. Meanwhile, if you have any query, please type in the chat box, because we're keeping a note of those queries, and we'll try to answer those queries as much as possible.
Yeah, Sumesh, can you share the presentation and start?
So just a minute, facing some issue. Allow me.
So meanwhile, can Jiten start his part, and then later on Sumesh can come?
Yeah, in interest of time, Jiten, can you share your presentation and show how to trade commodities on ICICI Direct?
Yeah. Can I start?
Yeah, Jiten, please proceed.
Okay, I'll do it after Jiten does it, sir.
Sure. Yeah, Sumesh, can you?
Do you want me to start, sir? Or should Jitendra do it first?
Yeah, you can go ahead, Sumesh, in case you can.
Thank you so much. So, very good morning, everybody. I am Sumesh Vaidya from MCX, and it's pleasure to be here with ICICI this morning. And thank you, each one of you, to kind of show interest in what commodities are. The previous speakers spoke in detail basics about what commodities are. Probably I'll not repeat what he has covered, but from exchange perspective, what is our role, or what do we do, and how does commodities market are important in the structure of the financial derivatives that we have. So if you broadly see the market, people understand capital market, which is the equity market, when people put in money to ensure that their capital enhances. They make money out of it by direct investment in equity, or via different modes like mutual funds or a PMS or the routes. Then we have debt market, market for bonds and loans. We have a big forex market, which we trade US dollar and indices, the JPY, and then we have commodity market, and also we have money market, which is market for liquidity market for money. If you see all these markets, it has an interlinkage with commodities market. How? Take an example of forex market. US dollar is the most commonly traded currency in the world when it comes to commerce. Any changes in US dollar, it has an impact on commodities, especially commodities for which the countries are import dependent. Take example of India. We import huge quantity of electronics, we import huge quantity of gold, we import huge quantity of crude oil. What if the US dollar increases from 73 to 75, 2 rupees per dollar? There is an increase, which means the price of commodity is bound to increase. Take example of debt market or international money market. If any change in the interest rate by the central banks of international market, it has direct impact on commodities, because the cost of money is going to go high, it's going to increase, and that's how the commodity market, the prices of the commodity will get impacted. Take example of capital market or equity market. The price signals of commodities, which basically are the raw materials for those companies, if it shows an increasing trend, you would see that those companies who are exposed to commodities, they are able to make better realization from their output products. Classic example was all the base metals in the last year, which had seen an increase.
क्या इशू हो रहा है, तो मैं अपना मार्केट और प्रोडक्ट पेज नहीं खोल पा रहा लॉग.
Hello. Yeah. So we had seen increase in share prices of all the metal companies. Take example of Tata Steel, take example of Vedanta, so on and so forth. Why? Because the prices of metals went on increasing, which means that commodity market is interlinked to all these markets, and you get price signals, you get signals from the commodities market, which will help you to make better investment or trading decisions in other markets as well. So I always say there are 4 pillars or 4 platforms for any market, especially when we talk about commodity market. One is the platform, a platform which is available for a very long period of time. The trading starts at 9 a.m. till 11:30 or 11:55 in the night. Why do we need such high extended trading timings? Because India, when we talk about internationally referenced commodities, India is a price taker. We do not have self-sufficient production to take care of our needs, and that's why we need to import these commodities from the international market. Now, because these commodities are traded elsewhere in the international market, to have an arm's length price to those markets, we need to have our markets available for trading, for hedging of market participants for until the end of the day. Precisely, our market starts at 9 a.m. till 11:30 p.m. or 11:55 p.m. There are other markets internationally who trade very long hours, like 20 to 22 hours a day also. Then second key is the product. Which products are presently available for trading in the Indian market? We started with futures of individual commodities. We trade futures contracts in bullion, which is gold and silver, the 5 base metals, 2 energy products, 3 indices, 2 presently available for trading, 1 yet to be launched in October, and then we have agricultural commodities. So please understand, what we trade is the contracts of individual commodities. I'm not going to buy physical gold. I'm buying a contract of a gold with a view that the price may increase in near future. So I put in money. Mr. Pankaj explained you the concept of leverage, which I'll explain you later in my slide also. So you're not going to put in the entire funds, but a small component known as margin, by which you can take a position in a futures contract, which is going to help you, stay invested in the market. Second is options on futures. And third, we have index futures. Now, presently, we have bullion index and metal index. These two are the sectoral index available for trading today, which represents what's happening in the gold and silver contract put together. For metal index, what's happening on 5 base metals contracts put together. And on 7th of October, we are going to launch energy index, a basket of crude oil and natural gas put together, wherein a traders can at the same time take a view on a sector, again, energy sector. So all these sectoral indexes are a portfolio way of investing or trading in a particular asset class, asset sector rather than an individual commodity itself. The third P is who are all the participants in the market. So we have day traders who wants to punt on the prices, on the volatility. We have hedgers, the actual commodity hedgers who would like to hedge on the commodity considering the price risk that they have. So we have a set of traders called arbitrageurs who would like to capitalize on the price difference of the same commodity between two markets. And for agri commodities, we have the farmer producing organizations who would like to come and sell their produce through the exchange. And fourth and most important is the policy. What are the regulatory policies for overall development of the commodities market? Like we have SEBI as a regulator since 2016. Post that, they allowed new products like options, new products like indices, new participants like mutual funds and AIFs, etc., etc. So what are all the regulatory policies for overall development of the commodities market? Now, this is very important slide. Before you start investing, trading, you have a lot of research available on the website, on ICICI Direct website, on the exchange website. What affects commodity prices basically? So when we talk about internationally referenced commodities, what are the prices ruling in international markets? So if you open a TV channel, you would see crude shown in dollar terms, $58, $57. Any impact of prices in the international market, which is generally the NYMEX market, it will have a corresponding impact on the Indian market also. Why? Again, because we import a lot of crude oil for our consumption. Forex rates, I explained you what if dollar goes from 73 to 75 or 73 to 71, right? Geopolitical factors, global and Indian, what's going to happen in Middle East, is somebody is going to take a call on cut down of production of crude oil or increase in production of crude oil. What's going to happen again in Afghanistan, and what are the political factors which are going to play? These all factors affect sensitive commodities like crude oil and gold and silver, so on and so forth. It does have an impact on commodity prices. Do we have any regulations in India, like tariff, non-tariff barriers with respect to import taxes? Like gold attracts a tax of import tax of around 13%. Does it going to have an impact? Any changes? Yes, it does have an impact on the prices. Then what are the economic factors of the country? Is there any recessionary trend, inflationary trend? Whenever there are inflationary trends, we see the commodity prices giving signals what's going to happen in near future. Is India being a consumption-driven economy? Is the consumption going to go higher, which we have seen in last 1 month, last 1 year during pandemic when everything was shut down, the economy was in negative growth. But when the people started consuming commodities again, we saw how the growth started. What are the employment, housing data, and other economic data from major economies like US, UK, and Japan? All these factors are going to have an impact on commodity prices and eventually prices of commodities in India. And when we talk about specific commodity related events, this impacts most of the agricultural commodities. What is the demand supply scenario of the commodity? Do we have good rains? Are we going to produce good commodity? Which means the supply is going to increase. If the supply is going to increase, which means that the demand or consumption remaining constant, the prices tend to correct. And the seasonality of the factors like marriages, harvesting. Whenever we see such events, people tend to buy gold. So whenever marriage season we have, the gold demand increases. We start importing a lot of gold and lower the prices of gold. People start going to the shops and buy. Eventually, you can also start looking at the derivatives of gold when you want to buy gold for investment purpose also. So broadly, these are the factors which impact the prices of commodities in India. Majorly, you could see are geopolitically connected, and what are the international factors playing which may impact the commodity prices. So broadly, these are the four commodity segments. Bullion, we have gold, silver. Metals, we have the five base metal products. Energy, we have crude oil and natural gas. And we have around agri commodities, we have around 91 commodities which are notified by the regulator for which we can launch the derivative contract. So at MCX, which is the highest traded contract, silver accounts for 30% of the total volume of the exchange. Gold is 26%. So roughly 56% of the volume of the exchange is from two products, which is gold and silver, followed by roughly 14% of natural gas and 9% by crude oil. Again, roughly 24%, 23% by energy products. So 60 plus 23, roughly 85% is by these four products, and rest is by the metals and other agri commodities. So which means that gold, silver, natural gas, crude, all internationally referenced commodities account for largest volume on the exchange platform. If we take an example of commodity to understand, I've just shown you on the screen, taking example of base metals. Just take one product like aluminum. It touches the transportation industry, the electrical industry, the construction, the machinery equipment, the packaging, so on and so forth, which means that any increase in price of aluminum, the signals given by the commodity derivative contracts will help these participants to take a view of how to hedge their raw material. And as an investor, when you know that aluminum is in shortage, or we're going to import a lot of aluminum, and the consumption of aluminum is going to increase because of aluminum being used in electric vehicles and so on and so forth. So you have a research paper on your hand or research information. You can invest in aluminum by coming on the exchange platform and taking positions on the aluminum futures contract. So this is how the commodities impact in India. Now, when we talk about commodities and equities, especially the gold contract and the benchmark Nifty, they are inversely related. If you see three red circles, when the Nifty was higher, the gold prices tend to go on the lower side. Simple, people would like to invest money in a fast making asset class. But when the previous year, around October 20 to April 21, you saw gold prices tend to go higher when the Nifty was falling because economy was not doing good. We had pandemic set in, and that's how this chart is showing again a very classic example that equity market and gold or overall commodities are inversely related. They have very low correlation, which means that you never know what's going to happen in future. Precisely, this makes a case for portfolio diversification. If you are investing some portion of your money in equity market, you need to have some part of your money invested in gold or commodities overall, which will help balance your portfolio in a better way. So this is an indicative examples of the products available for trading and the margin requirement to trade one contract of a commodity. Will not spend much time because the previous speaker has already spoken about it, but take an example of a segment bullion wherein you have a contract called gold petal, which is a 1 gram contract akin to an ETF, which is a 1 unit. The margin required is only 430 rupees based on the previous closing price, right? Which means that if I'm a new investor who wants to trade gold, to start off with 500 rupees, I can start trading a derivative contract in gold petal. But I want to trade gold and silver both put together. So either I can have two different contracts in gold and silver, or I can also trade index, the bullion index, which is composition of gold and silver put together with a margin percentage of 6% and an investment amount of around 42,000 rupees. You can easily trade both the products put together because it's a better way to start investing in commodities rather than having two separate portfolios. It's up to an individual and his choice to start investing. When we talk about energy, we have natural gas and crude oil. A new product which we are about to launch is energy index, having crude oil and natural gas at its component. The margins being both these products being highly volatile, the margins are around 11%. You would need 76,000 rupees to trade one lot of energy index. And then we have 5 base metal contracts and an index of 5 base metals put together. So if you want to trade 5 base metals individually, you can see roughly you would need 8 to 10 lakh rupees to trade each lot of aluminum, lead, zinc, copper, nickel. But if you want to trade all these 5 products put together via index, you would need roughly 58,500 rupees to trade all 5 products put together. So index way is the best way to start investing in commodities, as you're investing in a sector and not an individual commodity itself. And agri, we have cotton and CPO as the most 2 liquid contracts available for trading. So quickly, I'll run through a new product that we are about to launch on 7th of October, which is the Energy Index Futures. This is the history of 2 sectoral indexes, Bulldex and Metal Index, which we had launched last year. And both these indices are well received by the market participants. Please note, we have only futures of these indices available as of now. And looking at the success of both these indices, we are again launching a new energy index, a sectoral index, having crude oil with 75% weightage and natural gas 25% weightage. This is the contract design. The one lot is 125 units, roughly at a 5,200 value. The contract size is 6.5 lakh, on which 11% is the margin. Every 1 tick movement, you lose 125 rupees. The margins are roughly 11%. The daily price fluctuation is as designed for futures contract, which is 9% intraday and keeps on moving higher based on the volatility. You have monthly contracts available for trading. And most important, these indices are cash settled contracts, which means for an investor who would like to take a call on the energy sector of crude oil and natural gas, he can keep his position, he can trade till the last date because there is no delivery concept out here. Now, I've tried to draw a correlation between all the indices and the benchmark Nifty. The yellow line is the Nifty line chart. The green chart is the energy index chart. The red chart is the metal index chart. And the blue one is the bullion index chart, which represents the gold and silver component. If you see carefully, all are inversely related, right? Look at the green chart, energy index. When last year, April, the crude prices went negative, we have seen a huge drop in crude prices, right? And from there, it started to gain again. Blue line is the index line, the bullion index line, which is the component of gold and silver, inversely correlated to Nifty. The metal index, again, inversely correlated to Nifty as well as bullion index, both put together, right? Metal index truly representing the metal segment of India, again, inversely correlated to Nifty, which clearly shows that from a portfolio based approach to investing, if you have equity shares, that is via Nifty, and you have commodities via index, be it energy index, metal index, or bullion index, I'm sure you will be able to better manage your portfolio of investment when you have commodities as an asset class in your portfolio of investment. So these are general do's and don'ts before starting to trade in market. Most important is have research in your hand, study about that commodity, and then start trading. This is from a brief presentation from my side. If you have any Q&A, we'll take up during this session. Thank you so much. Over to you, Pankaj ji.
Thank you, Somesh. Hi. Good morning, all. Am I audible, Pankaj or Ramesh, sir, you can confirm? Yes, you're audible. Yeah, okay. Okay, thank you. Ramesh, sir, can you share the ICICI Direct commodity page, commodity market page? Is it possible for you? I'm facing some issue on commodity market and product page. Pankaj, in case you can open ICICI Direct commodity market page, is it possible for you?
Sure, sure. Okay, I'll open share. Give me 1 minute.
Yeah. So, yeah, good afternoon, all. I will take 10 to 12 minutes and I will show you how to trade on ICICI Direct platform. I'll show you entire trading journey, how you can enable your account in commodity, on which platform you can trade, and then how to trade and what are the information available on ICICIdirect.com. So right now you can see the ICICIdirect.com homepage. So on ICICI Direct site itself, on non-logged in section, we have provided multiple information on commodities. All the important information on commodities. So right now we have moved to the commodity page, that is the by default market page, where you can see the live rate. Today market is closed, but as per yesterday's closing, you can see the gold mini last traded price, what was the change, and then you have the future indices options there, and you can select other commodities also. Then you can see the high, low, open, close, all information. Right hand side, you can see the live charts that is also available there. You can use the maximum option also to check the historical chart also. Then below that, there is one important section called as a commodity brokerage calculator. Pankaj has explained in his earlier presentation that our brokerage is 20 rupees per order. You place order of 1 lot, 2 lot, 10,000 rupees or 1 lakh rupees or 1 crore rupees, you need to pay the fixed brokerage, that is 20 rupees per order. So with the help of this calculator, we are showing if you are trading in commodities and before start trade, you want to understand what is your expected cost for a particular trade. And suppose I am buying at particular X rupees and selling at Y rupees, what would be my profit? So with the help of this calculator, this brokerage calculator, we can check the all the profit and loss for my position. So see here, just you can see the buy price for gold is 45,000, almost 600 rupees, and selling at almost 900 profit. So you can see the buy sell turnover is 92 lakhs 49,500 rupees. But the brokerage for buy and sell, that is buy 20 rupees per buy, 20 rupees per sell, that is only 40 rupees. We can take 2 lots, 4 lots, but still the brokerage would be 40 rupees. So that 40 rupees only ICICI takes. So apart from that, yeah, you can see that when I have done the 2 lots, then the brokerage is 40 rupees. Though the trading value has increased to almost 1.84 crore, 1.85 crores, but brokerage is 40 rupees. Now, what are the charges, other charges apart from brokerage? As Pankaj has already mentioned, it is exchange transaction charges, that is 260 rupees per crore on buy and sell both the sides. Then SEBI charges are there, GST, and most important is CTT. Pankaj has mentioned CTT, he is charged on sale side of turnover. So it is the 1,000 rupees per crore. So for this trade, it is 930 rupees. Apart from the stamp duty there, and total charges are 1750. Pankaj, you can make the 1 lot if possible. Yeah. So in 1 lot, so I want to check what would be the my cost. So my expenses. So it is almost 900 rupees. Means to get the profit, to get the profitable point or to reach my break-even point, my commodity, my gold price should move by 8 rupees 99 paisa. Means if I am the buyer, I have purchased at this 45,995, then the price goes above by 10 rupees, I would be in a profit. So anything about 10 rupees or 9 rupees, that is my profit. So here I have sold in 600 rupees, almost 605 rupees profit. So my profit on this position is 49,600. So this way I can calculate profit and loss and other cost, break even, and that can be done before entering into the actual trade. Right hand side, we have given the calculator for commodity indices future like MCX Bulldex and Metaldex. Similarly, it is functions just like a futures, so you can compute the cost there also. Now below that, we have given the live commodity market related information, like which are the commodities are top gainer, top loser, then which are the commodities are active by value, means most of the trades happening in which commodities, then active by volume, and below that there are some information, there are some live news on commodity market. So this all information is available on ICICI Direct commodity marketplace. Means the path is that you don't need to log in. You just go to icicidirect.com, go to the commodity page, just like Pankaj navigated, and when you will click on commodity page, you will get this all market related information. Now we get multiple queries that where I can see some tutorials, some information about the product, where I will get some, can I get some videos to understand commodity marketing better. So yeah, it is possible. But beside this commodity market page, there is a page for commodity product. So Pankaj is navigating to that page. Just a moment. Yeah. So you can see after market, there is a product page. On this product page, you will get the various information on commodity market. You will get research reports also. You will get various podcasts. You will get various videos. Also, one section is there why you should trade with ICICI Direct in commodities. So definitely the our platform is very seamless, and you can transfer the fund very easily. Then we have the robust risk management. These are the some unique features we have on ICICI Direct. Pankaj, is it happening? Means,
No, I think there's some issue. I think
okay.
the backend.
Okay. Okay. Yeah, same issue I am facing at my end also, because there is might be the DR side. Okay. So I have the, okay, you have logged in. So just a second, Pankaj, I have the access for login section. I can log in from my end.
Okay, okay.
Okay. So on product page, you can move anytime and you can see various videos on how to trade in commodities, how to trade in indices, video on crude oil. So these are all information available on that commodity product page. So now the questions comes, on which platform I can trade in commodity. Means with ICICI Direct, can I trade to website? Can I trade to any application, mobile app? Yes, you can directly trade through this website. You can also trade through the ICICI Direct mobile app or old mobile app. You can trade in commodities. So this is available. Now the next question is that, is there any charges for opening or activating commodity account in ICICI Direct? So absolutely, there are no charges if you have the ICICI Direct account. So you can move to you can open ICICI Direct account, ICICI Direct commodity account online itself. You don't need to do any documentation, physical documentation, and you don't need to pay any fees for opening the commodity account. It is absolutely free. So in case you want to test, you can do that. Now the question comes, how I can do that? So yes, just like I have shown you, here is the login button. You just need to log in and you need to enter the ICICI Direct ICICI Direct commodity page. After entering the commodity page, I will show you through the presentation. Yeah. I hope my screen is visible. Yes. So this is the login page. After login, in case I am a new to commodity, I have never visited commodity page, so I need to activate my commodity account. And when I will visit the first time to commodity page, I will get a online terms and condition. I need to accept read that and I need to accept. After accepting this terms and condition, I will get this mandatory communication detail page. What is that? In this page, I need to give the preference to all the commodities. There will be the commodity list where I need to decide, I need to declare in which category I am falling. Just like you can see the farmer, FPO, value chain participants, others. So by default, or most of the customer would be in other category. Why? Because if anybody is involved in any kind of production of commodity or agriculture, farming of commodity, then he need to select farmer. If anybody is involved in any kind of export, import, or wholesaling of any commodity, then he can select the value chain participant. But most of the customers, most of the you would be the just like a retail trader, you are coming for trading investment purpose. So then you need to select others. So for your convenience, we have given by default selection on others. You just need to select on update button at the bottom of the page. Now, after submitting this, when will my commodity account will get activated? So answer is that in one working day, your commodity account will get activated. This process is same across the brokers across the India, because we need to share your KYC detail with MCX, then MCX verifies, and after that your commodity account gets activated. Yes, so in one working day, your commodity account will get activated. Now the question comes, how I can trade in commodities? So this is the commodity login page where I will get a various information, but I will show you what are the support research information we have. But before that, I want to show how you can start trading. So for trading in commodity, first you need to allocate a fund, just like you are allocating equity, F&O, mutual fund, IPO. Similarly, I have allocated 1,000 rupees here. In case you want to trade in some frequent, means your favorite contract, you can save that in your favorite book, just like I have read Bull Dex, Crude Oil Gold, and I can quickly buy and sell from this page. Now, in case I want to directly purchase from place order, here is the button place order, just like equity F&O. If you are new to ICICI Direct, you can open ICICI Direct account, then go activate your commodity account online, and then you can trade through this place order page. In place order page, I need to select, I need to put underline. Underline means in which category, which contract or which commodity I need to trade. I need to enter the code of that commodity. Just like I have entered the gold pay, that is gold petal. Pankaj has mentioned gold petal is the one of the variant of gold, and which is the smallest contract on MCX. So gold petal lot size is 1 gram. So 1 gram price is around almost 45,000, 4,500, 4,600. So the contract size is 46 or 4,500. And the margin required to trade in this contract would be almost 10%. In all gold variant, it is 9 to 10%. So you need to pay almost 450 or 460 rupees, and you can trade in gold petal. For testing, if you want to start, if you want to test, you can start with gold petal. So here I have entered the quantity 1. Now, while entering quantity, you have both the option. You can enter quantity in units or lots. Unit and lots means I will show you through the live website. Yeah. Yes. Suppose I am putting the gold mini. Gold mini. So gold mini, after putting gold mini, I need to click on select contract. Then there is a buy sell button. I have the multiple contracts available for trading October, November. Usually 2 to 3 months active contracts will be there. Based on the liquidity, this contract will be visible. Minimum 2-month contract will be there for trading. Suppose I am clicking on buy. Now the gold mini lot size is 100. You can see here, 1 lot equal to 100 quantity. So I have now both the option. I can put the 100 here, or I can, if I don't know the lot size, then I can put 1, 2, 3 in lots column, just like here I am putting 2 lots. So then automatically 200 will become here. So on the basis of the survey we have done and the convenience for the customers, we have given both the option. Anybody can enter quantity in units or in lots also, because in our derivative customer have habit to put quantity in units, just like Nifty lot size is 50, so they have the habit to enter the 50, 100, 150, 200. So we have given that facility also. But in outside world, commodity traded in lots, you might have the habit to trade in lots, so you can put 1 lot, 2 lot, 3 lot. That is possible here. Then after that, you need to enter the limit price or market price based on your choice. Just like I am putting the buy price at 45,000. So I can click on buy and I will get the verification page. So on verification page, I will get all the verification detail, means all the contract detail, quantity, price, what I have entered, what would be the trade value, the contract value, or that order value. So all this detail I will be getting here. Now, after confirming that, after click on proceed, I will get the confirmation page that my order has been sent to exchange. Now, all the order which have been sent to exchange will be visible in order book option. This is the order book page here. On order book, I will see all my ordered, cancelled, rejected, executed. All order would be visible here. But I want to check what are my traded, executed orders. So those orders will be visible in trade book. So here is the trade book option. Under trade book, you can see my 2 orders has been executed. Buy order as 4804, sell order as 4811. and what is my trade value. And after market gets closed and BOD process gets completed, I can see the brokerage and taxes in brokerage and taxes column. So this way I will get the information of my executed orders. This process is similar to equity. In case you are trading in equity or future and option currency in ICICI Direct, the process is same. Now this is the most important page on trading journey, that is open position page. In open position page, I will get all the open position, means wherever I have taken the position, those positions will be visible in open position. Like I have taken the gold petal position, so this position is visible here. What is the quantity? That is also visible. Then what is the average price of my purchase price? That is available here. And also what is the price going on? That is also available here. Then here is the square up option. Square up means if I have taken the buy position, I can sell that, means I can close that with the help of this square up button. If I will click on square up, I will get a similar page which I have used for buying this commodity, means order placement page. Now there is also the one button instead of this square up at market. In new website we have new version, we have the profit and loss button, where I can see the profit and loss of this position. In chat I have seen one question that where I can see my profit and loss. So for all the open position, all the live position, my profit and loss would be visible in this open position page under the profit and loss button. So you can see that profit and loss. Now the most important part I wanted to cover, commodities are volatile. Pankaj has mentioned in one of the slides, commodities are more volatile. So I need to be careful about the available margin at my commodity position. So here for this position, I have given the 495 rupees as the margin. My 495 rupees has been blocked. And here is the one column, second last column, showing that minimum margin. The minimum margin is 4030 rupees. So exchange says that anytime you should have this minimum margin in your account. Otherwise, your position may go into risk management system and your position may get squared up. How? Suppose I have purchased this position 4,800 and suppose this position going down and it is down by 100 rupees. Now the price has become 4,700. So that 100 rupees notional loss would be deducted from my provided margin. So suppose I have provided 495 rupees as a margin for taking this 1 gram position, then that 100 rupees will get deducted from 495 rupees and my available margin will show 395 rupees. So now my 395 rupees available margin is less than minimum margin. So my position is in risk. My position is danger. And ICICI system may square up this position. And in case ICICI Direct square up the position from online system, then you may need to incur the 50 rupees for square up charges also. So we get many query that, sir, I had a sufficient fund in my bank account, I had some extra fund in my equity segment, IPO segment, mutual fund segment, but still my position got squared up. So we cannot touch your other segment or other your bank account. So what is the solution for avoiding this system square up? Because of notional loss, or there might be one reason that this exchange has increased the margin. So in that case also my available margin may be the lesser than the minimum margin. So how I can avoid this system square up? So simple solution is that keep the extra allocation of fund in commodity segment. Like in my first slide, I have shown you that I have kept I have allocated 1,000 rupees. Here you can see I have allocated 1,000 rupees. My margin required is 495, but I have allocated extra 505 rupees. So similarly, you just need to keep extra fund just like 20%, 30% of required margin in your commodity segment. So what will happen whenever your position goes into this risk management because of margin requirement, your available margin less than minimum margin, then system will automatically pull extra required margin from your commodity allocation if you have the pre-allocation in commodity segment. So I hope this is clear. You need to keep extra margin in commodity segment to avoid system square. Now going ahead, where I can see the profit and loss of all the close and open position, historical position. So this is available under portfolio page. Under portfolio page, I can see here is the profit and loss column. Here is unrealized, realized. So all the open position profit and loss will be visible in unrealized column, and all the historical close position profit and loss will be visible in this realized column. I can select the month from month to month based on my expiry date, traded expiry date, and I can check the profit and loss, and total would be visible in this column. Total of unrealized and realized column. Again, I want to show you with the website where I can see this profit and loss statement in case I want statement for income tax purpose. So here is the button under plus button. Here is the commodity menu. I need to enlarge my commodity menu. Then last option is profit and loss statement. So under profit and loss statement, I can get the profit and loss statement year wise, financial year wise. Just like I want to check for current financial year, I just need to click here view. Yeah, the date wise I can see the profit and loss, and I can download this report in PDF, Excel, or CSV format, and I can use for my income tax filing. Similarly, we have the transaction statement report. Transaction statement report. Under transaction statement report, we can see my historical transaction statement, quarter wise, year wise, just like you can see the April to June first quarter of the financial year 2022 or full year fiscal year 21. I can download this PDF reports. This is also can be used for your various purposes. Now, the most important question. Yeah, I understood how to trade in commodity, where I can get the statement, profit and loss statement, how to activate commodity, which platform is available for trading. Now, what are the support system or research support I will get on ICICI Direct? So all kind of research recommendation, all kind of research support you will get on ICICI Direct. All kind of research support means you will get live recommendation of commodities for trading in day or intraday. This live recommendation will be available under this I click to gain page. If I will click on I click to gain page, I will get all the recommendation. There would be the recommendation for equities also, but I can filter the commodity recommendation just like you can see the metal deck, crude oil, gold mini. We have given recommendation. I will take the example of metal deck top one. We have given the recommendation this yesterday around 6:15 p.m. Target was this, stop loss was this. Profit has booked at this level, first target, then second profit has booked at this level. That profit has been booked at this. So you have the complete transparency at what time we have given recommendation, what was the price that time, and at what time we have given the closure remarks, means profit book or in case there may be the stop loss. So all this information will be visible. I just wanted to highlight that we have the almost 70 to 75% strike rate, means out of 10 recommendations, 7 to 8 goes into profit. There might be the 1 or 2 recommendations which may go into loss. So that you need to take care. So always follow the recommendations blindly. You take the recommendation, all the recommendation, definitely you will get good returns. Here is the direct buy sell button also. In case we have given the buy recommendation, here is the commodity future buy. You can click here and you can reduce your order placement time. Contract and everything has been selected. You just need to enter the quantity and price and you can submit the order. So this is on research. Apart from that, we have the daily commodity research report. I will open and show you. These reports come every day in the morning around 8:30 a.m. You will get what happened exactly in commodity market yesterday, in global market, in domestic market, and what is expected for today and short term. So this way you can get this report. Yeah, you can see what was the recent development, what was the price in global market, international Indian market, MCX market, what is the short-term outlook, bullion, energy, all these details you will get. What are the event are scheduled for the today? So this all information you will get with the timestamp. So it means 6 o'clock, there would be the initial jobless claim. Then natural gas storage data would be around 8 o'clock. So this information you will get here. Some problem in my navigation. Yeah. So, apart from that, you will get monthly commodity derivative reports also. Yes, under monthly commodity derivative report, you will get research report on commodities for 1 month view. Means this report comes in the first week of the month, means beginning of the month. You will get the complete view on all the commodity, all the major commodities for the month. Like we have given this report on 1st of September, where we have had a highlight that gold prices may remain positive towards 49,000. So this report is available Then apart from gold, you will get the recommendation or report and view on other commodities also, just like crude oil and other commodities. What are the event or what is the other information is there? You can get all this information in this report. So this way we can check commodity reports. Now this is all about the research report. If any special report would be there, it would be available here. We are also coming with the weekly report. That report will be available for you. Then apart from that, we have the few podcast on commodities. In case you want to understand commodities again, here is the podcast on basics of commodities. Then here is the podcast on monthly commodity research outlook, which I talked about the reports. So that information available. Then the presentation shown by Pankaj on commodity market is available here. You can click on this commodity presentation. You get all the commodity related information from this presentation. And also the presentation or demo I am showing about the commodity, how to trade in commodity. That demo or that presentation commodity order placement process is available under this how to trade in commodity. Just I am showing, just I am clicking on commodity presentation. You can see this presentation under login section. So anybody from you can download this presentation anytime it is available. You can get the information, what are the commodities, what is the history, all details you can get through this presentation. So this is all from my side. So Ramesh sir, we can open the session for question and answer in case.
Sure, Jiten. Dear participants, hope the presentations were useful. My colleagues have tried to keep it as simple as possible. So thanks, Jiten. Thanks, Somesh. Thanks, Jiten, for these presentations. And in case you have liked this presentation, please type good in the chat box. I request participants to type good in the chat box. And there have been many questions in the chat and I've been trying to answer. But nonetheless, we'll take up those questions which we have missed till now. Guys, before we move forward, we are running a campaign, a customer campaign. Apart from having this brokerage of just rupees 20 per order, executed order, there's a special campaign that we are running for all those customers who have not traded in commodities till now. And this campaign starts from Monday and it will be applicable till 29th of October 2021. I'm just sharing the link in the chat of YouTube. Just give me a second. I'm just copying the link and pasting it in the YouTube chat box. Thank you. I can see a lot of comments. Thanks for your appreciation. Jay says good. Kishore says good. Simi Nayak, great. Thank you. I've just pasted one link in the chat box. You can click on that link for all those customers who haven't traded commodities, right? So you can use this link, register yourself by putting your match ID. Match ID is nothing but 10-digit number, your registered number. You can put the match ID, and after registration, you'll be getting 1 month brokerage free. So all the trades that you do till 29th of October, max up to 1,000 rupees would be reversed in the month of November. Jiten has just highlighted the match ID on the screen. So that is the 10-digit number that you need to put. There was also a query from Jitendra Singh, and he was asking what is the match ID. Jitendra Singh ji, just copy and paste this match ID of yours. We'll get back to you on your relationship manager. So this is what I had to say. I request each one of you to click on the link right now and register for all those who haven't traded so that you can get access to this brokerage reversal for all those first-time commodity traders. Yeah. Jiten, I think we can move on to the questions till participants click on the link and register.
Can you see the link? Pankaj, can you see the link? I am not able to see the link in chat box till now in YouTube. Pankaj, you can confirm.
Just hold on. I'm not able to see the link. I think Ramesh is.
I've just pasted the link once again. Can you just check? It's icsadirect.site/commodity.
Have you put in YouTube or in
YouTube? I put it in YouTube link.
No, I cannot see that link.
Okay. Let me just type in the chat box. I've just pasted, but let me just type. Give me a second.
Yeah.
Can you check now? I've just typed https://idirect.site/commodity. So that is the link that one needs to click. 1236 is what I pasted.
I have put a link here. ICC demo videos from my ID, from demo videos.
No, Pankaj, I'm not able to see. Okay. Jiten, can you let me just Jiten, can you just show the link on the screen?
No, I've already shown it. It's there. It's there.
Jiten, can you share the link on the screen?
Just a second.
Yeah. I've just typed in the chat box, or you can just paste it on the Word file and show it on the screen. Great, guys. So in the meantime, till Jiten pastes the link on the screen, maybe Jiten, you can type it on the, paste it on a Word file and show it on the screen. Let me just take the questions. We try to answer as many questions as possible, but let me open the questions. Pankaj, till I open, in case you can see any of those questions, you can start taking those questions.
Okay, let me check. Am I audible?
Yeah, you are audible. Please go ahead.
So there's one question from Jiten saying cash buy and cash sell. I think you already replied. But yeah, but for the convenience of all, actually currently commodities are available for trading in futures and options form. At an exchange level, spot market is not available. So when you trade in any commodities contract at MCX, you trade in futures contract or options contract. I hope this answers like buy and sell query. Why government has stopped crude mini contracts? Well, if Sumesh is there, then probably he can answer it better.
Okay. In the meantime, are you able to see my screen? Is my screen visible to you on the screen? Rishi, in case you can help, I've just put the link of https://icicidirect.site/commodity.
Yeah, it's there.
Yeah, this is what is the URL. You need to click here and then register for the offer. Yeah, we can take the questions. Over to you, Pankaj. Yeah.
Yeah. So Sumesh, if you can answer this query.
Sure. So basically, we had crude and crude mini contracts, but then the regulator was of the view that we could have only one contract, so that the liquidity is majorly built up on one single contract, having no sense in having two contracts with the same underlying. There's no rocket science of why mini contracts are not available in crude oil, but that was the idea. Having said that, we may represent to the regulator for smaller investors. We could have small size contracts in crude oil, but not too sure whether we'll be getting permission for trading. But as of now, we have the larger crude contract with 100 barrel trading lot size.
Okay, thank you. So there is one question from SK Kavita. Can you explain more on options contract and commodities and how to trade on them?
Yeah, Pankaj, I'll take this question. Options will be up. Now, options is picking up traction and a good share of volumes are happening to options. And shortly, you'll have options also to trade. And we'll do an exclusive webinar on options only. So that because it's something which requires at least half an hour to 1 hour's time, at least 1 hour's time. So definitely we'll post again and do an exclusive program only on commodity options.
Okay.
Yeah.
There's another question from Anand Kumar. Watchlist and chart analysis is not available in ICICI Direct.
Yeah, currently watchlist and charts are available for equity derivative currencies. Commodities will be up soon, maybe month of October. Yeah.
Okay. Now there's a question from Dwarki D. Please suggest websites to track the price volume action of commodities.
We have a markets page itself where you have the volume, where you'll be able to see volume, where you'll be see the OI. And once charts are also integrated, you'll be able to get the entire information on ICICI Direct site itself. You need not go anywhere else searching different sites.
Right. And they can go to MCX site also, and they can check the volumes of daily traded commodities there. Okay. I think this is so far from the participant side. In case if we have any important point to highlight, then we can put it across.
Yeah, there was one question. Somebody wanted to understand the stop loss order. Jiten, in case you can help on that, that's thing which got missed. So it's important. I'm unsharing the screen. So
Yeah.
dear participant, this is what is the link. You can click here, put your match ID and mobile number in case you haven't traded. So you'll get a confirmation on this, right? Yeah, I'm just doing a stop share. Jiten, you can do the stop loss screen share.
Yeah, so right now I'm on again the commodity homepage after login. Am I audible?
Yes, yes.
Yes, you are.
Okay, thank you. Screen is also visible, correct?
Right.
Yeah, okay, thank you. So whenever I have any buy position, suppose I have purchased anything at 100 rupees and that commodity is going down by 98, 97, and I want to stop my loss at suppose 96 or 95, then I can put my stop loss order and I can restrict my losses. So how to do that? So if I have the buy position, I need to go to the open position page and there would be square of options, just like I have shown in my presentation. Yeah. So I have shown in my presentation, there is square up button. You just need to click on, right now I do not have any open position, so you just need to click on square up button. After clicking the square up button, you will get a similar page just like I have the order placement page. Suppose for example, I have position in gold. I will get similar page. Whenever I will click on square up, I will get same page. This is gold sale order page. Now when I have the position of suppose one lot, then here is under more option, I have the stop loss trigger price, SLTP section. What is that? Now suppose I have purchased this commodity at 46,000. Now going down and I want to stop my loss at 45,000. So I need to mention that 45,000 at SLTP price. Here I have written SLTP as 45,000. Now above that there is a limit price. So I need to give some range. So below the SLTP, I need to enter the some limit price just like 44,800 rupees. I can provide that limit price here and I can put the stop loss. So right now, when the price is going around the 46,000 and I'm entering this stop loss order of 45,000, till the time the price doesn't cross this, doesn't go down below the 45,000, my order will be in inactive status in passive book of exchange. Because it is a conditional order. Stop loss order is conditional order. I am giving some condition that in case price goes below the 45,000, my order should get executed. I should exit. So when I will put this conditional order, my order would be in passive book. At the moment this last traded price crossing the 45,000 level, going below 45,000, my order will get executed. In between this price range, my order will be active at this price 44,800, and whatever the best price below the 45,000, my order will get executed. My stop loss order will get executed. So please remember, when you are putting the sell stop loss, this is sell stop loss. You had a buy position at 46,000. You wanted to put a stop loss at 45,000, 1,000 rupees down. Then your limit price should be less than stop loss price. Stop loss price will come first, then below that the limit price. But you may have the opposite situation also. You have the sell position. Suppose you have sold one gold contract with the outlook that the gold may go down. You have sold at 46,000, for example. Then you have a risk if in case the gold goes upwards, it's become the 46,500, 47,000, then you have risk. So you want to stop your loss at 47,000, suppose 47,000. Then you need to enter that 47,000 as a trigger price, and above that there will be the limit price, just like a 47,500 or 300 rupees. You need to enter limit price above the stop loss trigger price. So this way you can put your because market price is currently at this level. So this way you can put your stop loss price. I will show you again sale side. Then I will put stop loss price of 47,000. Now the price is going around 46,000. I am putting my stop loss at 47,000 and limit price is 47,500. I will click on sales. I will get order.
So Jiten, a query could be here.
Yeah.
Do we need to put a stop loss in a range bound price, for example, trigger price and limit price, or could a trigger price could only be mentioned?
No, both the price need to be mentioned. As I mentioned, for sell stop loss, in case you have the buy position, you want to put a sell stop loss, then suppose I have the buy position, I have the sell position, then my trigger price should be lesser than limit price.
Yeah.
But in case I have the buy position and I want to put the sell stop loss, then my limit price would be below the trigger price.
So both the prices need to be applied.
Mentioned, yes.
Okay. And one more question could be that when a fresh order is placed, would a stop loss be applied at that time only, or it could be applied only after having placed a fresh order and later on going to open position?
Yeah, the process would be that first you need to take the your fresh position. Suppose you want to buy, you need to buy that. Then go to the open position page. There would be the square up option, and after that you need to put the stop loss order with the help of square up button. Means both the order you need to place separately.
Right. Thank you, Jiten.
Yeah, there's one more question from Shanmugam, which is the continuation of stop loss. He's asking whether the stop loss should update on daily basis for positional trading or one time is okay.
Yeah, it is a good question. Stop loss cannot be put positional. You need to, in case your stop loss not hit on a particular day, doesn't hit, then you need to put stop loss on daily basis. You need to put fresh stop loss on daily basis. It can't be positional.
Great. There's one more question from Ramapati. Actually, it's not a question, but asking for some correction. Ramapati Devi, point noted, what we meant was the risk reward for 1 kg and 100 grams gold, which is mentioned in the PPT. But nonetheless, we'll mention risk reward there. Jitendra Singh ji has been posting again and again. Please put your 10-digit match ID number. We'll revert back with the concerned relationship manager. I know it's 12:50 now, and we have totally run out of time. We thought of 50 minutes, but I believe it was an interactive session with lots of questions and great presentations by all the three presenters. Hope all the participants have benefited out of this. And dear participants, will continue to do more webinars, more YouTube lives, and we'll have different topics going forward. Thanks for taking off time and connecting on this webinar or YouTube live. So we would like to conclude the session here. Take care, be safe, and thanks.
Thank you very much.
Yeah.
Thank you very much. Thank you, everyone.
Thank you very much.